Good afternoon. It's Jeff Christian. It's just afternoon on Tuesday, the 14th of December in New York. I wanted to talk to you a little bit today about gold and silver prices. Rational and irrational expectations perhaps might be a good subtitle. And then I also thought I should talk a little bit about money supply and inflation. Here's the gold price. And it's interesting. Take a look at the gold price. It's through December 9th, 1799.30 was the average price through last Thursday. That's 2.5% higher than the average price for all of last year. And the average price for all of last year was a record price. You can see on this chart that the price was higher than it had been in the 2011-2012 period. And because the price of gold was high in the first half of 2020, but not in the second half of 2020, but not in the first half of 2020. This year, it's been higher throughout the year. So the annual average price is actually higher. So we'll have a record gold price on an annual average basis this year. Silver, it's not an annual average price, but it's up 63% in 3 years. You know, the annual average price was much higher back in 2011. The gold price rose and silver price was perhaps stickier than the gold price back then. Silver price on average is probably up about 23% from where it was last year on an annual average basis. And as I said, you know, if you go back to that cyclical trough, which actually was on an annual average basis, the trough was in 2018, it was about $15. The price is going to be about $25.30 this year. We're breaking below $22 today, and I'll get to that in a minute. But the price is up 61% in 3 years. The interesting thing, and the reason why I laugh, is that record gold prices, 61% increase in silver prices. And one of the common questions we get over and over again is, why aren't gold and silver prices rising in the face of inflation and COVID and the pandemic and all of the political divisions within the United States and the risk of a coup in the United States at some point, and the tensions that range from the Russian border with the Ukraine all the way to the South China Sea. So many things going wrong in the world. Why is it that gold and silver prices aren't rising? And the answer is, well, they are rising and they have risen and they're very high. They're very high by historical standards. Investors have been buying a lot of gold and silver last year and this year based on safe haven, portfolio diversification, currency hedge, even an inflation hedge. So there's this disconnect between people who have these irrational expectations of how high gold and silver prices ought to be, and the reality of the fact that gold and silver prices really are higher. Our view, as you probably know, is that next year the prices are probably going to continue to tread water, sort of the way they have this year. This is silver. Let's go back to gold. We do think that there'll be a period of time when economic and political and financial problems become much more virulent than they are now. That may not be 2022, might not even be 2023, but probably at some point in the next 4 or 5 years, you'll see a round of hostile economic, financial, and political conditions. And that probably will coincide with investors buying more gold and silver and driving the prices even higher. But probably not now. In the meanwhile, people who have rational expectations and understand the precious metals markets are quite pleased with the fact that they bought precious metals earlier and that gold's at record levels and silver is up sharply. Now, this morning, the producer price index data came out for the United States, and it was very high. Nothing surprising there. The biggest increase probably was in transportation costs for goods being shipped around the country. And it was very interesting. Gold and silver fell. and they fell significantly. Gold broke below 1780 and got down to 1770. Actually got below 1770, although it's come back around the last half hour or so. Silver broke below $22, which has been support for a few weeks, and it got down into the 21, 22 range. And that's worrisome because, as we've said in our trade recommendations on gold and silver, for those of you who get those, and in our videos, we think that silver prices are more vulnerable to the downside than gold, but they could lead gold lower over the next few weeks or so. And that continues to be. The dollar had fallen prior to the release of the PPI data, and it's actually come back a little bit since then. Interest rates didn't rise, oil prices didn't rise, and the stock market kind of yawned. It fell slightly after the PPI came out. It fell, the S&P fell a little bit more later in the morning, but the Dow Jones is still hanging up there relatively well. So there's some confusion that we're hearing in the markets as to how it is that you have very high PPI and gold and silver prices fall. And I think that if you look at gold and silver and oil and the dollar and the equity markets and the interest rate markets, you take the whole financial market complex, what markets seem to be saying is that they do not collectively think that inflation is so much of a problem, and they believe that the Fed can successfully quell inflation with monetary policy, insofar as it's monetary policy that has been driving it that way. So one of the questions this morning was, do we issue a new gold trade recommendation and a new silver trade recommendation because prices have fallen in a way that we had predicted? And the answer is we will wait to see where the prices settle today when the COMEX closes, and we'll probably issue trade recommendations either later today or early tomorrow. But we're waiting to see where the prices settle, because as I said, so gold prices already have come back up a little bit more. So that's gold and silver. I want to talk a little bit about monetary aggregates, inflation, and gold. I don't really want to talk about it, but, and we've gotten a lot of comments about how money supply, inflation has to go skyrocket because money supply is higher. And I don't like spending my time reacting to comments like that, but I think given the prevalence of those comments, it behooves us to revisit things. Now, we went through this just 3 weeks ago. On November 23rd, our video covered economic factors, including monetary aggregates, inflation, and gold in a lot more detail. So these charts and tables are from that. Things haven't really changed. If you look at the relationship between money supply, you can look at M1, you can look at M2, you can look at M3/MZM, broad money supply, and you look at the relationship between money supply and inflation, not particularly good over time. If you look at money supply versus gold prices, it's not particularly good over time. What I'm saying is that increases in money supply do not necessarily lead to increases in inflation, and increases in money supply do not necessarily lead to sharply higher gold prices. Common misperception. And you know, this is non-lagged. You can lag it. You can lag it 3 months, 6 months, 12 months, 18 months, 24 months. You don't necessarily see that. Let's look at some charts. And you've seen these before 3 weeks ago, but we've used these charts for many, many decades now. This is M1, the blue line, and the red line is inflation. And you can see since the early 1980s, repeated periods of time, 14% increase in money supply, 18%, 15%, 10%, 18%, 20%, and now we're up here around 65%. And in each instance of higher money supply growth, abnormally high money supply growth, you haven't seen it translated into inflation, because those periods of high money growth are followed by the Fed basically sterilizing the inflationary consequences by selling bonds and sopping up the excess liquidity. Now, as I've said repeatedly over the last 12, 24 months now, this is different. I mean, we're not going up 15, 20%, we're going up 65%. But that said, not the thing, it's not different. So we are seeing some inflationary consequences. Inflation has gone from 0.5% to about 2.5% on a month-to-month basis. It's gone up to about 4 or 5%, which is a level that we haven't really seen since the 1970s or the beginning of the 1980s, when inflation was 14%. We have to wait and see. But history tells you that money supply increases do not necessarily get reflected in inflation. It's true looking at narrow money supply. It's true looking at broad money supply. We don't really spend a lot of time on M2, but it's the same data. You can see it. -6% M1, -8% M2, -17% for M3, MZM. And there's some interesting reasons that I won't bore you with that, about why it's a much bigger increase in disconnect between money supply and inflation for broad money supply. And quite frankly, a lot of mainstream economists don't look at broad money supply expressly because there have been structural changes in broad money, the content of broad money, over the last 40 years. Which has rendered it less indicative of where we're going economically and in terms of inflation. And then if you look at money supply versus gold, it's not there. If you look at inflation versus gold, it's not there. Inflation has picked up. This is only through 2020. But inflation is now up about 6%. So we're getting up back into this area that we saw in the 70s. But the important thing is that if you look, gold prices have gone from $250 in 2000, 2001 to record levels of around $1,800, rounded up from $1,799, 30. Let's say $1,800. Record gold prices over the last 20 years in an absence of inflation. So you don't need inflation to see higher gold prices, and you don't need to sit around saying, well, if we have big money supply growth, and if we have inflation, ergo ipso facto, it has to be reflected ultimately in gold and silver prices. Our schedule for next year: 3 gold, silver, platinum group yearbooks over the first half. We will have a platinum seminar called The Future of PGMs in late January. We will have an online seminar called Energy and Metals in early February. We'll be involved with the prospectors and developers. We'll have an online seminar on silver in early March. And then we will have a Future of Gold physical roundtable with the IPMI in April. You can learn about our work, buy our yearbooks, buy other research, retain us as consultants at our website, cpmgroup.com. That's all I have for today. Take care, and we'll talk again Friday.